Warren Buffett is considered by many to be the greatest investor of all time. He bought his first stock all the way back in 1941 when he was just 11 years old. Since then, he's amassed a fortune worth over $107 billion. Despite his vast amounts of wealth, Buffett is mostly known for his frugal lifestyle and simple investment strategies. He's often said that his investing philosophy is to be fearful when others are greedy and greedy when others are fearful. This investing philosophy is based on value investing, which he defines as the process of buying stocks that appear undervalued by some measure and selling them when they appear overvalued. Now, the stock market can be difficult to understand at times, especially when you're first starting out. So with that said, in today's video, we will be going over Warren Buffett's top 10 pieces of advice for beginner investors. But before we start, make sure you like this video and subscribe to our channel for more awesome content. Number 1. Form good money habits. In a 2007 address at the University of Florida, Buffett said, "Most behavior is habitual, and they say that the chains of habit are too light to be felt until they are too heavy to be broken." Basically, what Warren Buffett is saying is that good financial habits take time to form. Most of us realize this too late in life. Building good money habits is key to improving your financial situation. If you habitually spend more than you earn, you'll likely find yourself in debt and struggling financially. On the other hand, if you develop a habit of saving and investing your money, you'll be on the path to financial security. One easy way to start building good money habits is to track your spending. Track where every penny goes for a month and see where you can cut back. Maybe you can cancel some subscriptions or reduce your eating out budget. Number 2, invest in yourself. When it comes to making money and building wealth, one of the smartest things you can do is invest in yourself. Buffett said, "Invest in as much of yourself as you can. You are your own biggest asset by far. Anything you do to improve your own talents and make yourself more valuable will get paid off in terms of appropriate real purchasing power. Anything you invest in yourself, you get back tenfold." Of course, this isn't easy. It takes a lot of hard work and dedication to improve your skills and knowledge, but it's definitely worth it. The returns you can achieve by investing in yourself are huge, much bigger than any other investment you can make. So if you want to become wealthy, start by investing in yourself. Number 3, invest for the long term. In his 2014 letter to shareholders, he said people should invest with a multi-decade horizon. Their focus should remain fixed on attaining significant gains in purchasing power over their investing lifetime. He urged investors not to focus on moments of stock market volatility or economic crisis. It's important to remember that the goal with investing isn't to get rich quick, but to build long-term wealth. That's why Buffett recommends focusing on the long term, especially when it comes to buying stocks. When you invest for the long term, you're not worried about short-term market fluctuations. Instead, you're looking at the big picture and buying stocks with the intention of holding them for years or even decades. This type of investing can help you achieve significant gains in the long run. Plus, when you invest for the long term, you're taking advantage of compound interest. This is when your earnings from investments start to earn interest of their own, which can lead to even more growth over time. So if you're looking to achieve financial success, focus on the long term and invest for the future. With patience and perseverance, you can reach your goals and enjoy all the benefits that come with them. Number 4, cash is always king. When it comes to running a business, cash is always king. This was a lesson that Warren Buffett learned early on in his career, and it's something that he has never forgotten. He once said, "We will always have a lot of cash on hand. There have been a few times in history, and there will be more times in history, where if you don't have it, you don't get to play the next day. It's like oxygen. It's there all the time, but if it disappears for a few minutes, it's all over." Cash is the lifeblood of any business. It's what keeps the lights on and the doors open. It's important to have a healthy cash reserve on hand so that you can meet your obligations when they come. Buffett is a big believer in keeping a healthy cash cushion. That way, he knows that his business is safe no matter what happens in the markets. Cash is also essential for making investments. When you have cash available, you can act quickly when an opportunity presents itself. This kind of goes against the current startup culture of debt-fueled growth, but if young entrepreneurs can balance their debt and cash reserves, they can make their startups more sustainable. So if you want to run a successful business, make sure you always have plenty of cash on hand. It will give you peace of mind and help you take advantage of opportunities when they arise. Number 5, only invest in what you understand. One of Buffett's key pieces of advice is to invest in things that you understand. This means that you should have a good understanding of the business you're investing in, what it does, and how it makes money. One way to improve your understanding of a company is to read its financial statements. These statements show how much money a company makes and how much they spend. They also show how much debt a company has and how much it owes. By reading these statements, you can get a good idea of whether or not a company is healthy and growing. Another thing to look at when investing in a company is its competitors. You want to invest in companies that are doing well, so it's important to know who their competitors are and how they compare. Warren Buffett, for instance, only likes investing in companies who are leading their industry. He's a large investor in Apple, who are leading the way with their innovative tech products such as the iMac and iPhone. He also invests in Coca-Cola, who are the biggest soft drink brand in the world. Number 6, focus on value instead of timing. Buffett tends to focus purely on value, not on timing the market. This means that you should consider how much you're paying for an asset relative to what it will produce. If the asset is undervalued, it may be a good investment even if the market is in a downturn. Similarly, if the asset is overvalued, it may not be a wise investment even if the market is doing well. It's important to remember that no one can predict the future of the stock market, so trying to time the market is a risky strategy. It's much more important that you're investing in assets that are worth your money. Number 7, the compound effect. Compounding is the process of earning interest on top of interest. It can be extremely powerful if you start early and let your money grow over time. Compounding over the long term is the secret to generating wealth. Warren Buffett is a master of compounding, and it's the main reason he's been able to accumulate such a large amount of wealth. Let's look at an example. Suppose you're 20 years old and you invest $10,000 with a 5% rate of return. If you add $500 of your monthly savings to the initial investment and keep doing this till the age of 65, you will end up with almost $1,048,000. Now, if you used the exact same strategy, but instead started investing at 30, then by the time you reach 65, you'll only have $597,000. By starting 10 years later, you could miss out on $451,000. The key to compounding is to start early and let your money grow over time. If you can do this, you can achieve incredible results. Number 8, avoid debt like the plague. In the 2013 Berkshire Hathaway AGM, Buffett told a 14-year-old investor to avoid getting into debt. It's very tempting to spend more than you earn. It's very understandable, he said, but it's not a good idea, and if you're deep in the red, it may be a good idea to never look at a credit card for the rest of your life. Now, debt can be helpful in many cases when it comes to building wealth, but it's a double-edged sword, and if you don't know how to use it, you could end up losing a large chunk of your savings. For many people, it's a good idea to avoid debt altogether and just focus on investing the money you do have. The best way to avoid debt is to live below your means. Don't spend more than you earn and make a budget that you can stick to. If you already have debt, work on paying it off as quickly as possible. Make a plan to pay off your balances in full each month. You'll be surprised at how much money you can make by getting rid of your debt. Number 9, invest in low-cost funds. One of Buffett's key recommendations is to invest in low-cost funds. By doing this, you'll be able to keep more of your money invested, allowing it to grow over time. Additionally, by investing in a diversified mix of assets, you'll reduce your risk of losing money. For instance, Buffett urges the average investor to purchase index funds. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. He wrote this in his 2013 letter to Berkshire Hathaway shareholders. Buffett has given this advice for years. He says, if you invested in a very low-cost index fund, where you don't put the money in at one time but average in over 10 years, you'll do better than 90% of the people who start investing at the same time. Number 10. Most news is just noise. Another important piece of advice from Warren Buffett is to ignore the news. Most of the time, it's just noise that can distract you from what really matters in investing, which is proper research and analysis. Buffett has said on many occasions that he only reads the financial pages of the newspaper. He doesn't watch TV or pay attention to the news. He only reads stories that are related to his current investments or potential investments. It's important to remember that news is often just speculation and opinion. It might be interesting, but it's not always right, and it can distract you from your investing goals. Instead of getting caught up in the latest headlines, focus on analyzing and researching investments. That's how you'll make the best decisions, not by listening to all the noise and jumping on the next trend. What do you think? Did you find these tips helpful, or were there any that you disagreed with? Let us know in the comment section below. As always, I hope you enjoyed today's video, and I'll see you in the next one.